Hello everyone, this is Equity Management Academy, with a Gold Weekly Standard Deviation Report, for June 17, 2022. Summary. The weekly trend momentum of 1871 is bearish. The weekly VC PMI of 1844 is bearish price momentum. A close above 1844 stop negates this bearishness neutral. If short, take profits 1805 to 1767. Next cycle due date is July 1, 2022. Trading instructions. Weekly trend momentum, 1871, bearish. The gold futures contract closed at 1841. The market closing below the 9-day SMA 1871 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Cycle. The next cycle date is due July 1, 2022. Strategy. The weekly trend momentum is bearish unless it closes above 1871. Weekly price momentum, 1844, bearish. With the market closing below the VC weekly price momentum indicator, 1844, is confirmation that the price momentum is bearish. A close above the VC PMI would negate the weekly bearish short-term trend to neutral. Cycle. The next cycle date is due July 1, 2022. Strategy. The weekly price momentum is bearish unless it closes above 1844. Weekly price indicator. Exit, longs. Sell 1, 1881. Sell 2, 1920. Exit, shorts. Buy 1, 1805. Buy 2, 1767. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 1805 to 1767, and go long on a weekly reversal stop. If long, use the 1767 level as a stop close only, and good till cancelled order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1881 to 1920 during the week. Cycle. The next cycle date is due July 1, 2022. Strategy. If short, take profits 1805 to 1767. If long, take profits 1881 to 1920.
Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk. I wanted to share with you the report that we published last week, the Gold Weekly Report, and see basically what has transpired for the rest of the week and get some insight on maybe what's going to happen here sometime over the next week or so. We have what I see is a lot of green on the screen here today. And let's take a look at the gold market here. On the right of the chart here, you see today's activity, and we have seen a lot of volatility in the gold market here today, with the market stabbing into this blue area that we call the area where you accumulate inventory, where you accumulate supply. Even though we may see a bearish indication here, the idea is to expect these kinds of reversions from this level. We have activated a buy trigger, and we are long the gold market on a close above 1826. The weekly target that we just reviewed has the buy 1 level at 1805. and the standard deviation weekly is 1844. We have not been able to come down lower than what we saw today, 1770. The previous low was 1806, that was made on June 14th. Excuse me. And as you can see here, the market reverted from these levels, or every time it's come down into these levels, it offers a mathematical probability that a reversion is likely to unfold. And as you can see here, reaching the extreme above standard deviation. On the daily, we begin to see the red highlighted above 1852, and the blue highlighted obviously below 1826, as low as 1805. Now, the 1844 is a weekly average. 1838 is the daily average now. And the yearly average that we're looking at is 1840. Excuse me, 1849. So what you see here is the market entering into this mean or average on the yearly basis. And on the 16th of June, we got up to a high of 1861. And by all intents and purposes, the fact that the market is trading below the yearly average, it has a bearish price momentum. This is the monthly. This is the monthly average. This is the monthly average. And we looked at the annual average to be about 1840. So we have the annual average at 1840. We have the monthly average at 1849. And you can see if we go to the weekly, 1844, and the daily, 1838. So the range of 1838 to 1849 is pretty important, and it is identifying the equilibrium in price of the standard deviation in all the trends. And if we take a look at the market short term, we've come into, again, the area where the standard deviation is at the extreme below the mean, and it's recommending mathematically that this area is a good area to accumulate inventory. And so when we take a look at the signal short term, we can begin to see there's some buying interest in the 1826. Not quite coming down even to the buy one level daily. So this is the math of the market. But the volatility right now is being influenced by a couple of factors. You're looking at interest rates. The talk is basically about interest rates and how the Feds are going to control the record level of inflation that we're running, which is at a 40-year high. And we have seen the 10-year note shoot up to as high recently of about 350, which was the reason why we saw this correction in the equity markets recently. The yield has come down into 307 now last, and what looks to be the possibility that if we get under 3% on the yield, then it indicates that it is discounting the possibility that the high levels of inflation that we have seen, the energy prices reaching once again close to that 120 area, might be already discounted in the market. And remember, the futures markets always discounts the fundamentals ahead of the fundamentals. Fundamentals are always lagging the market. So we have the stock market here today sharply higher. We have the NASDAQ sharply higher. And I think the market is already discounting the talk on the street, which is hawkish from the Feds, about raising interest rates 0.75 of a point on the next meeting. One of the things that I think over the years it's been evident to me that the only one that knows where things are going is the market. And the market obviously is affected by primarily the cost of money. I think if we take a look at it and we analyze the currency, the US dollar, the underlying asset of all of these instruments is the US dollar. And the US dollar has recently been challenged, obviously, because of the tremendous amount of stimulus that came into the market as a consequence of the pandemic. And it exploded the balance sheet to where it's, I think, gotten currently, which is like $9 trillion. So it's important to understand a couple of things as far as I'm concerned as a trader. These elements are a little bit out of whack to me. And, I think we're looking at the possibility that we could see some tremendous volatility into the market. And the question is, to be on the right side of that volatility. And so when you take a look at the situation with regards to interest rates, when we're dealing with the debt factor of $30 trillion in debt, interest rates going up already is beginning to take a toll on the expense, on the tail end of this debt, which is exploding. For every % increase in interest rates on a $30 trillion loan or debt, you're looking at $300 billion in interest payments alone. And the geopolitical crisis that we're dealing with Russia and Ukraine, devastating the chain supply situation, energy prices, crude oil prices, and driving pretty much the Western world economies to a standstill, particularly when it comes to grain production, which is at question right now. The new planting season is in question right now. And how much grain is going to be available to meet the world demand is questionable right now. And so you're looking at the fundamental picture, what I believe is unfolding to be pretty bullish. And so I think the Fed is in a dilemma in terms of how fast they need to raise interest rates to catch up to inflation. The reality is that the market already has done the job of raising interest rates without the Feds. And I think that's what we're beginning to see and discount in the equity markets. And I think the momentum, it's just a matter of time before it moves into, you might say, precious metals, other assets that have been affected or potentially could be affected by an increase in interest rates, financing, leasing rates, shipping rates. Everything that is financed is under pressure from the previous rise that we have seen, not by the Feds in interest rates, but by the market itself. And the reality is that even if you're looking at a 3% yield, 3.50 yield, when you're looking at inflation running at about 10%, you are still running a negative yield in relation to inflation and in relation to the purchasing power of the US dollar. And so, if we take a look at the choices here, number one, the Feds cannot raise interest rates aggressively because it will destroy the world economy. It will destroy the status, you might say, of this country and the currency as the U.S. world's reserve currency. So the challenge here for the U.S. is not only to keep rates reasonably following the market without disrupting the market, adjusting to its inflation pressures, and basically allowing for the economy to recalibrate. So the question is, how much further is inflation going to get worse over the next 6 months? If we take a look at the current situation here, coming back here to the market, we already have seen the reaction of interest rates in the commodity markets. We have seen a reaction, for example, in wheat. coming down from 1363.50, which was the high that was made on March the 8th. And this was just moving into the volatility based upon Russia invading Ukraine and anticipating the shortage, or what is going to be the damage done in grains, in particular in wheat. And obviously, until that happens, the market will trade, tested the high on May 18th of 1280, and it has reverted right back down into what appears to be getting close to or below a 61.8% Fibonacci retracement, which ideally identifies the possibility that the correction of this move, of this first leg, might be reaching levels where to expect a reversion to unfold. And that's happened pretty much, across the board. If we take a look at metals, back on March the 8th, we saw a high of 2078. This is due to the Russia-Ukraine crisis. And the same thing with the metal. It's discounted whatever damage was done at that point, and now we're beginning to see the reality of the war, and I think getting into levels that we could be activating some buy triggers to the upside. And I seem to have focused on the gold market because I use the gold market as an indicator for a lot of other things. Not just as a tradable instrument, a commodity, a metal, an industrial metal, an investment metal, but it's an economic indicator. It's the other side of the US dollar. And obviously, if the US dollar is in jeopardy and continues to be, as we continue to build more debt, and we are borrowing basically just to monetize the debt, just to pay interest rates on the debt. So interest rates cannot go up, or it might have already topped, as well as inflation, based upon the previous numbers. And that's already been discounted in the market by the correction that I'm pointing out to you. Has occurred pretty much across the board. What I'm getting to is that now the market is looking for the potential damage that truly is in being done, and we're going to begin to see a lot of that damage, a lot of the, you might say, victims as a consequence of the sharp rise that we have seen in interest rates since 2020. It's risen tenfold. Mortgage rates have almost doubled in just the last 6 months. So we have yet to see the consequences of this, and I believe the market is preparing and saying basically that it's going to be real difficult for interest rates to move higher. The economy is now demanding that interest rates come down, which is totally the opposite of the fundamentals. And if that is the case, these markets are going to see a massive explosive move to the upside. Just to do a recap here for my traders in Discord here, continue to hold on to your derivatives long. Use the obviously targets for day trading, and prepare for what I believe is going to be a rally across the board coming up. And that is what pretty much the variable changing price momentum indicator is pointing out to us. We have reached the extreme level of standard deviation 1-to-1 and 2-to-1, and is offering a tremendous opportunity to buy the market in stocks, to buy the market in commodities and precious metals. I want to wish you a very safe and happy weekend. Please enjoy your family. Be safe. And I will see you next time. Be well.